Can you keep up with the pace of market regulatory reform? MarketsReformWiki.com, the place to keep up.
I think in Europe, the creation of the euro was a huge change, a huge shift in the interest rates environment. And the main sort of 64 banks got together and created a new benchmark rate called Euribor, the Euro Interbank Offered Rate, which is calculated and distributed via the European Banking Federation. And they decided that they wanted that to be the new benchmark for the euro interest rate futures and options on futures curve. And so NYSE Liffe had to move quickly as an organisation to make sure its open interest, which was currently primarily in the old euro mark, the old Deutschmark interest rate futures, could easily be transferred over to this new benchmark rate, which it did successfully. Globally, the quick move and quick and coordinated move by the central banks towards near zero rates, subsequent to the financial crisis, has forced people to completely reassess how they look at the interest rates market. People initially thought that this would be a relatively short-term phenomenon and we would recover from the financial crisis quickly. Of course, we're now sort of 4 years in, and it looks like this is the new normal. Where the front part of the curve is going to have, very, very flat rates, and people will increasingly look to trade further down the interest rate curve. So the challenge for us is to provide that liquidity into the red months, into the green months, into the blue months, and even out to the gold months, so that people can take exposure, hedge positions, further down the interest rate curve. I think it's the same for London-based traders as it is pretty much for everybody globally who are trading interest rates. You are looking at those back months now. The red months and the green months, open interest has grown to record levels, whereas the white months are very, very static. People have pretty much got a clear view of where rates are not going to move in the next year. But there is continuous speculation looking at GDP figures, looking at retail sales figures, looking at employment figures, manufacturing figures across both the Eurozone and the UK to actually have a view on when the European Central Bank and the Bank of England may move those rates upwards. Of course, there's lots of different competing factors. The interesting thing within the Eurozone, you have very, very divergent economic performance. You have German powerhouse, which is clearly benefiting from a relatively low value of the euro on the currency market, continuing to grow. Their manufacturing base is very, very strong, but also surrounding that you have a lot of weaker economies. In the UK you have quite a unique situation as well, where the quantitative easing programme by the Bank of England is very, very large and significant, and that's going to have a significant long-term impact on the UK economy. The important thing for us is we've managed to offer additional liquidity into those back months to allow traders to actually hedge themselves or gain exposure through those back months. The pack and bundle market on both sterling and Euribor has grown dramatically for us, and that trades very, very actively now. And those markets didn't actually exist on Euribor and sterling a few years ago. We have a well-established and well-known product called the Euro Swap Note, which does replicate the returns of a swap. And this product has been around for quite a while. It is already listed on the Liffe platform. It's already cross-margined against other like products. It's cross-margined against Euribor. It's cross-margined against other bond products as well. All it needs is a little jump start in liquidity, and you'll see that in a very short period of time. That product will jump start. It will have proper support from some tier 2 banks within the swaps market, and we think this will offer a very attractive alternative to the creation of brand new instruments which are untested, unknown, and brand new exchanges which again largely untested, unknown. The long-term interest rates trading cannot really converge around a single sovereign in the way it has in the past. And also the absence of a European government bond That's not going to be created, we don't believe, for some years to come. So hence Euro Swap Note has a very good opportunity now to capture a lot of the OTC trading, which will be, through higher capital charges. A lot of the interbank trading will be forced onto recognised venues such as exchanges and clearing houses. Potential creation of new indices such as the DTC GCF repo product. I think re-looking at overnight indices, such as Ionia, Sonia, Ronia, these can be potentially new benchmarks for the future. But the market wants to return to a level of normalisation, and that does mean a return to actual interbank unsecured lending. When that's actually going to happen is anybody's guess. I think the real new product opportunity for us, as I mentioned, is to generate more liquidity into swap notes. Obviously, we have the Euro Swap Note already listed. We can offer a dollar version of this contract, we can offer a yen version, we can offer a sterling version. So, and expanding, that franchise, beyond, the single European currency, I think is a great opportunity for us.